Okay, from my own little understanding, I think it's unethical. Reason is, I believe it contravenes the provisions of IS-1 that has to do with presentation and preparation of financial statements.
Okay.
In the sense, um, loan per se is supposed to be a different components of financial statements and not to be included in that component of cash and cash equivalent.
Mm,
Because cash and cash equivalents, they are like assets, they are more like liquid assets of the entity that can easily be converted into cash. That's just what it means. But for
mm,
that loan to be included, it, it's unethical because
mm,
it's not something that can be converted to cash instantly.
mm.
So I believe it's something that should take at most a year or thereabout. So that's just my input. Thank you.
Okay. So, do we have anyone else who wants to say something?
Hello, sir.
Yes, sir.
Just to add to what he said about the presentation,
Mm,
so that but the aim of the present financial statement is to give a true
mm,
view. The director's loan is supposed to be listed as a separate line amount, not under cash and cash equivalents,
okay.
because it is just that's just what I wanted to add to what he said. He has already said most of everything.
Okay. Yes, any other thing? So, ordinarily, right? Loan to directors. Normally, in what's it called? What's this standard? This related party transaction standard, right? Now, if there is any
IS-24.
IS
24.
24, now if there is any loan given to a director, it has to be stated, right? So, for instance, where you have a related party transaction, who is that related party? What's the nature of the transaction? What's the amount? I think all those things. Now, where there is a loan to a director, not a staff loan, no, not an advance, so a loan to a director, it has to be stated under that IS 24, right? And again, you can't even give a loan to a director without having it on a separate line item. So just like what someone said, now when you give a loan like that, it's just like what it's doing is that give me that loan. I will not let the management to know that you've given me a loan. Just put it as if the money is still in the financial statement. Leave the money as if the money is still in the cash book, in the cash and cash equivalent. Whereas the money has gone out. Now, probably in the process of third party confirmation, you now realize that why is your cash and cash equivalent uh, less than 1.5 million of the amount stated in the financial statement? Then you now say, it was a loan given to the director, but yet it was not stated, it was not shown at all. So you gave a loan to the director and you didn't show it, and the director is trying to cover it up. So definitely it's unethical. All right. So when you give a loan like that, you have to record it separately, right? You have to record it, and of course, it's a receivable, right? Is it not a receivable? It's a receivable.
Yes,
So, but not cash or cash equivalent. All right. So that's it. Okay. Now that's being said. Now let's go back to our list. What do we have on list? So information two above. How do we treat the list? Information 2 says that a new asset with a fair value of 1.5 million was acquired during the year under a lease agreement by Bola Limited. Now, a clause in the lease agreement stipulated that 300,000 payments, 300,000 naira payments must be made on the 31st of December. When did we purchase the lease? It was purchased during the year. And what is our during the year in this question? 2018, right? So it was purchased during the year 2018, and a clause in the lease agreement stipulated that 300,000 must be paid by December 2018, right? Each by December 2018, December 31st each year for 6 years, starting from this same December 2018. All right. So that means we'll be paying 300,000 for 6 years. Am I right, please?
Yes.
So
Yes, sir.
300,000 times 6 is what? 1.8 million. Is that it?
Yes,
300,000
sir.
times 6 is 1.8,
Yes,
Yes.
sir. 1 point.
right? Okay, now
Yes.
1.8 million. But what's the cash price? The new asset with a fair value of 1.5 million. That's the
Yes.
cash price, right?
Yes.
Do you understand what I'm saying?
Yes, we can. I
Yes,
understand.
So
you.
1.5 million is the cash price,
Right.
right? But we have to pay
Yes.
1.8 million every year.
Every year.
The
And
interest implicit rate in the lease is 5.47%.
yes.
Gola Limited treated this as an operating expense because the only accounting entry that the company believes must be made in relation to this asset is a 300,000 payment it has made. Only the 300,000 you have made is what was recorded, whereas that is wrong. Abi?
Yes.
So you can't record only the 300,000. Instead, what do you do? What do we do instead, guys?
I think
Yeah.
the remaining balance should go to the financial
Don't forget,
provision.
oh, they're asking us how to treat the transaction.
Okay.
So how do we treat this transaction in the first place?
We recognize the transaction as a lease
Hmm.
under the IFRS 16.
Okay.
We we debit the 1,500 and one million five
1.5
hundred
million.
thousand
Uh-huh.
under non-current taxes with the heading of right of use and credit liability and credit under lease liability under liability.
Okay.
So for that is but we now uh, we now calculate the depreciation on over the year, which is 1.5 divided by 6. We now recognize that 1.5 divided by number of year, which is 250. We debit the pin and N and credit the right of use
I don't know. Does anyone
liability.
understand what he's saying?
Yes.
Okay.
We
Go
now
ahead, sir.
we now go we now go ahead to go and do the amortization table where we
Okay.
know the number go to the current, I mean not current liability and the current liability. We
Okay.
calculate we for the opening of the opening that balance under the amortization. We calculate interest on it on interest on the 1.5, which is 1.5 times 4.7 divided by 100, which is 82,050 naira. We add it to their amounts and deduct the repayment, which is 300,000 per month. And
Okay.
that's the closing balance. So when we do the amortization table for this year, we now that interest will be equal to in and air. The
Okay.
difference between the opening balance, I mean the closing balance, and the following closing balance will go to the current liability, while the that closing will go to non-current liability.
Okay. So thank you very much for that, right? He has given us the walkthrough from the beginning to the end. All right. So without wasting any time, let's take it one after the other again, right? Now, the question has given us all of this. So how do we treat it from the beginning? So let's take it a step by step. This one is May 2023. Question 1. This one I'll write financial position here because it wasn't a financial statement, not a full financial statement, but financial position. So let me take the one for financial statements now. Okay, now the first one says that how do we treat our lease, right? So let's take them one after the other. Just like he said, we are treating it under IFRS 16, right? And then in our recognition, we'll be recognizing the right to use the asset and the lease liability. I'm sure we've done something like that in lease. And again, for those of you who are offering advanced tax, there is now lease accounting in taxation of leased assets. Has anyone gone through it?
Yes, sir, chapter 12.
Okay, chapter 12. Thank you, sir. You even know the chapter. Now, so IFRS 16 taxation, lease, right? In our lease recognition, how do we recognize it? We have to recognize our right to use the asset, which is the cost price. But in this case, they gave us the fair value, which is the fair value of the asset, and then recognize our lease liability using that same amount as well, right? Now, in the initial recognition, what do we use? We debit our right of use asset and credit the lease liability. Am I right?
Yes.
Yes, sir.
Okay. So for initial recognition, what's the name of the account, please?
Bola, Bola Limited.
Bola
Bola
Limited,
Limited.
right? Now, in this question, is Bola the lessor or the lessee? A new asset was acquired at a fair value. Definitely, Bola is the lessee, right?
Yes.
Bola is not the lessor, he's one paying. That's why we have it as a liability. Okay. And Bola Limited.
Sorry, please, sir. Can you indicate the question you are solving? Maybe like at the top. Just for reference to the beginning.
I usually do. I don't know what happened today.
I think
We have May 2022, question 1. May 2022, question 1. Shall we proceed?
yes, please.
So A
Yes.
talks about lease. Lease, right? Leased asset. So how do we treat it in our initial recognition? Don't forget they're asking us of what to do to it, right? In our initial recognition, what do we do? So we have recognition, right? We have what again? Measurement, we have presentation, and we have disclosure, right?
Issue.
So in our initial recognition, what do we do? We debit rights to use assets,
Set. And credit.
right?
This obligation
Is it right to use or
This
right of use assets?
of this asset.
Right of use asset at how much? 1.5 million. And also we credit the leave liability
This liability.
with the same 1.5 million naira. Okay? Okay, fine. That's that. Now, the next thing is our measurement, right? So if we are to measure this asset now, we have the initial measurement,
Yes.
right? And when we are measuring it initially, we are to use the present value of the lease payment,
Hmm?
right?
Yes.
Now, for this question, they gave us 300,000 to be paid for 6 years. Now, that 6 years, it is a constant payment. It is an annual constant payment, right? For that 300,000. Now, this 300,000 that is given to us will be paid for 6 years. right?
Yes.
It will be paid for 6 years.
Yes.
Do you understand?
Yes.
Aha. Now, so that makes 1.8 million, right?
Yes.
Okay.
That's,
Now,
that's the-
1.8 million is now that 300,000. Since it is an annual payment, we can make it annuity.
Yes.
Since we are paying the 300,000 for the next 6 years, we can make it
yes.
annuity, right? But don't
Yeah.
forget the 300,000 for this year will still be at zero, right?
Hmm?
So in total, no, we are paying it for 6 years, starting from this year, the end of this year, right?
Yes.
Aha. So what I mean by at zero is that year zero, because this year is 2028, 2018. Am I right? But leave that year zero or whatever. Now we are paying it for 6 years. That means we can use annuity. Who remembers the formula for annuity?
We cannot see the working border, please.
No, we've not done any working board. I'm showing the question. We are reading the question. Can you see the question?
Yeah, we can. I can see
And
it.
that's what I'm showing.
Okay. Okay. Thank you.
So what is the formula for annuity?
One minus bracket 1 plus r raised to power n over half.
Raised to power
N over
minus
R.
minus
No, raised power
over
minus N all over R.
R.
Yeah, 1 minus 1 plus R
Bracket.
raised power minus N all over R.
Yes.
That is for annuity, right?
Yes,
Now,
sir.
in our annuity now, what is our R?
Our, I don't know. Should
Is
be
certain.
5.4.
Eh? Then
Point
that is the
5.4.
interest.
5.7.
That's the interest rate implicit given to us,
Yes.
5.47, right? Then
Percent.
our N
Yes.
is what?
Yes.
For 6 years,
For
6
6 years.
years. Number of years.
right? So now, so ordinarily we have to do the year, the cash flow, and then, but we don't need to do that since this is a cumulative cash flow and it is an annuity. So we can do cumulative
Yeah.
cash flow, right?
Cumulative.
Cumulative discounting
Yes.
factor, right? So for our cumulative discounting factor now, uh, we may not be able
Sorry.
to use
Sorry.
it.
Since we are. Sorry, sir.
Yes, sir.
I said, since we are reporting for just 2018,
Mm,
I think we should not use annuity to get that whatever we want to get.
okay, so
So
we'll
for
still
us
use
to be able to
annuity.
pick between 2018,
We will still use annuity, sir. Why? Because the
okay,
question is not telling us to prepare for 2018 only. The question
okay,
says
okay, okay,
the question says that prepare the necessary adjustment to account for the lease contract based on the additional
okay,
information.
okay,
So it's
okay,
from
okay.
start to finish.
Finish good.
The question did not
Thank you.
restrict us to 2018. So
Okay,
that's why we'll not do 2018.
okay, okay, okay.
All right. Now,
Thank you. Thank.
so our measurement. So for our measurement, we have our uh yes, well, we have to find the PV now, right? The present
Yes,
value of our liability. So what will be the present value now? We said the payment multiplied by the cumulative discounting factor, right?
yes.
Aha. So what will that give us? I can't write the formula here on Excel. I hope you guys understand. And that was why we mentioned it out. 1 minus 1 plus R raised to power minus N all over R. That's the cumulative discounting factor, right?
Okay. So,
What do you say?
5.000.
So our
One
PV will
plus.
be equals to payment times cumulative discounting factor, right?
no,
Aha. So what is our payment?
300. No.
300,000.
300,000.
No.
Okay. So that's 300,000 multiplied by what will be our cumulative discounting factor?
5.00.
5.00.
Yes, sir.
Okay, so that is 5, right?
Yeah.
5.00. And that will give us what?
How did you get that 5.00?
1
1.5
minus
million.
1
That is
plus
the
r raised to power.
annuity solution.
Eh?
Okay.
The formula for discounting factor is 1 minus 1 plus r raised to power minus n all over r. 1 minus 1 plus r raised to power minus n all over r. Does that answer your question, sir?
Yes, sir, but I don't know if it's possible for you to help us write it by the side, just so we don't forget.
Let me bring out my notes. So I think it can still be better written and even that one self. Okay, let me bring the notes. Here is our PM. Okay, let me bring the notes. If I can type out the formula. Or let me get it from my material here and then send it to the screen. Cumulative discounting factor. Okay, I can screenshot now. Okay. Can you see my screen, sir?
Of course.
Okay, so this is the cumulative discounting factor. 1 minus 1 plus r raised to power minus n all over r. 1 minus 1 plus r raised to power minus n all over r. Yeah? Who is that person? Oh, hello, that person can mute, please. Mr. La. Yes, have we done it, please?
Yes, sir.
Okay. So can you tell us your figures now, sir?
Hello, sir. Please, what's the rate in the question?
The rate is given
Five
to us
five
as the
point
implicit
five point
rate.
seven. I mean 5.47.
Okay, thank you.
Let's know when you get it, please. What do you have, please? Hello, what do we have?
For the
5.000.
measurement will be 1,500.
1,500. So shall we proceed now?
Yes, sir.
Okay. So this gives us 1,000.
For how many years? For
The
how many
question gave
years?
us 6 years, sir. The question told us 6 years.
Okay.
Shall we proceed now?
Yes.
Okay,
Let
that
us
means
continue, sir.
our present value is 1,500, right? Let's just write it in for 1.5 million naira.
And then make this 300,000. Okay, good.
1.5 million naira is our PV, right?
Yeah.
Now,
Yes, sir.
PV is 1.5 million. Now, okay. Now, if we've recognized it now, this PV is the minimum lease payment amount that will be recognized from the inception of the lease, right? Over the lease period. This is the present value we'll be recognizing. Am I right, please?
Yeah.
Yes, sir.
Now, so the next thing we'll now have is that what to be our subsequent measurement. Initial measurement is this. These are initial measurements. Initial measurement. So what will be our subsequent measurement? Yes, what will be our subsequent measurement? That's where we now have sorry. Sorry, what do you say, sir?
Okay, so divide the 1,000 million divided by 6.
6 years, for depreciation purpose, right?
Yes.
Okay. So depreciation is 1.5 million divided by 6 years, right? And that gives us what?
250,000.
Eh?
250,000.
50,000.
250,000. Now,
Like, you don't put 6, only put years.
sorry.
Like, the 1.5 million divided by years. There's no 6, they only include the years.
Oh, okay. Divided by 6 years, right? That's it.
Yes.
Now, what else do we have? Now, with this one now, of course, what do we do to our depreciation every year? 250,000 will be depreciated every year, right? That means
Yes.
250,000 will be debited as part of your expense in the income statement, and then you
Yes.
credit it on from your right to use
Out of
account
you.
in that asset account, right? To
Yes.
reduce the value. And then at the end of 2018, your net book value will now be 1.5 million minus that 250, right?
250.
Am I right? That will be your net book value. So depreciation for the year is this, right? 250,000. So which means uh as at 2018, 31st December 2018, right?
Yes.
Don't forget this one is depreciation. No, we don't prorate. Oh. This is not
Yeah.
capital allowance. They said they bought it during the year, but we don't prorate. All right. Now, as at 31st December 2018, the value of the asset cost at the beginning. No, let me bring it here. The cost,
At the
the
beginning.
cost at the
Sorry, sir,
beginning.
please, what could the month was stated as at when it was acquired?
Sorry.
Even if the month, I say even if the question states the month the asset was acquired, no need to prorate the depreciation.
No, we don't prorate depreciation. We don't prorate depreciation. I've never seen a depreciation prorated. No, like I'm not talking of uh, when you have a financial position to do. But here now, okay, let me reframe my statement so that you don't mix it. For instance, now, if a company has purchased an asset in August and then there is end of the year, of course you prorate, right? Yes, that one, that's not what I mean here. Please don't let me miss. Uh, okay, let's just leave it. So you prorate your asset, but in this case now, we're not told when it was purchased, right? So let's assume that it was purchased at the beginning of the year, and if it is not up to 12 months, they should have told us, right? And when it is not stated like that, we don't need to prorate. We assume that the position for the year is still 250,000 for the year. All right. So that's it. Now, the value of the asset as of 1st of January
2018.
2018,
Yeah,
cost is how much?
It's 1.5
Cost is how much? 1.5 million,
million.
right? 1,500,000. Let me use 1,500. 1.5 million, right? Then we
Yeah.
have depreciation for the year to be what? Minus 250.
Giving us 1,250.
Okay, this thing is not. Hold on, please. Let me put my naira sign here in thousand.
In million. I mean, okay,
No, no, no. I'll do in thousand.
in thousand. Good.
So my cost
1.5 now.
cost is 1,500, right?
Depreciation. Yeah,
And
depreciation.
depreciation
250.
is what 250, right? So with
Yeah,
that, at the end of the year,
we have 1,250.
yeah, 1,250, right? Now this is NBV as at 31st December.
This current amount.
Am I right? So 31/12/2018. That's the NBV. That's the value of the asset,
Yes.
right? Aha. Okay. Now, if this is the value of our asset at the end of the year, right? So what else do we have? Now, don't forget we've not done the what's it called? Our lease liability. We've not done the implicit rate interest for each of the transaction, right? The opening
Yes.
statement, the opening figure, the installment, the implicit rate, and the closing, right? So let's quickly do that as well. So here we'll be having the years, right? We have the opening figure, we have the installments. Now, are we paying in advance or in arrears? Are we paying
area,
in advance or in arrears?
area,
Yeah.
area.
Okay, we are paying at the end of the year, not at the beginning
Yes,
of the year, right?
yes.
So is our installment coming before the implicit rates or after?
After,
After.
You are sure it's after the implicit rate?
yes, after
It's
we
after.
calculate the interest from it.
Before the implicit rate, before the implicit rate.
It's after now. When we are paying at the end of the year, we calculate the amount, we calculate the rates, add it together and minus the
Installment.
payment.
Okay, thank you very much, sir. So since we are paying now, this is it. Whether before or after, this is how you will know it, right? At the beginning, if you are paying at the beginning of the year, it means you would have paid your installments. Then when you
Yeah.
deduct your installment from the opening balance, the difference is where you will now charge the interest rate, because interest rate is usually charged at the end of the year. Now, if you have paid your installments at the beginning of the year, it means, for instance, now 1.5 million naira is the cost, right? Now, if I am paying my installment of 300,000 at the beginning of the year, it means that before they can charge me interest rate, I would have paid my interest. I would have paid my installment of 300 from that 1.5. That means
Yes,
the interest rate will be charged on 1.2 million. not on 1.5 million. Am I right?
Yes.
Do we
Yes,
all
sir.
agree? Do we all understand what I'm saying?
Yes.
So the interest rate will
Yeah.
be charged on the balance. But in this case now, I am paying at the end of the year. So if it is at the end of the year, it means they would have charged me the interest rate for the whole year. Then I will now deduct my installment from whatever balance I have there. All right. So interest implicit rate at what? 5 point what, F?
47. It's not 47.
5.47. Are you sure, please? Let's go to it if you're not sure.
Check
Is
it.
it 5? Where is it? Roman figure 2. Yeah, 5.47%. All right. Now, then you will now charge your installment, and after your installment, you have the closing figure. Now, in the first year, which is no, before I go to the first year itself, let me use the. Should I use 1,000? Should I use this per 1,000, or I should just write naira? All of them is in thousand, so let's use thousand. This one is in percentage, and this will also be in thousand. Okay, now, sorry, sir, we are almost done.
Sorry.
Yeah, okay, so in the first year, our initial amount is 1.5 million, right? Now, that 1.5 million, let me write 2, 3, 4, 5, 6, right? So let me have all of this so that I can know this page to put in. Now, this 1.5 million naira that I have, they will charge me an implicit rate of 5.47% on it. What would that give us?
82.05. I think.
General.
82,000,
82.05.
82,000, right?
Yeah, it's 82.05.
Okay, that's
Zero.
82,000.05 will be 82,050 naira, right? And then we paid our installment of how much? 300 at the end of the year. So what would the balance give us? Yes. What would the balance give us?
1,282.05.
Uh-huh. 1,282.05. 1,282.05. Okay. Then we come to the second year. We also have 1,282. Let me automate it, please. This is Excel, so I should be able to make use of it. 1,282.05. All right. Then this. Okay, I think I should have used this already too. Times 5.47. Okay. 5.47%, right?
Sorry, I think the
And
closing balance 1,11795.
how did you get that, sir?
That's the installment in addition with the implicit rate minus the opening balance.
No, you can't minus the opening balance now. The implicit interest rate is additional expense you will pay. Hello, hello. Please, if your place is noisy, please you can mute. All right. Is this thing not warning us yet? Okay, that means we are not leaving yet. Okay, we started at 9:40. If we started at 9:40, it will soon give us 15 minutes to go. Now, so your interest rate is an expense. So your interest rate will not go like that, right? Now, this is your interest rate. you add it to your opening balance. You are paying these two. Out of these two, you paid 300. Right? Out of 1,582, you paid only 300. So that's why you have it at 1,282. Do you understand that, sir?
Okay.
Uh-huh.
Okay.
All right. So now I'll just automate this closing balance as well. Now the second year, right, is also what we have here. I don't know if I can use this. So what I did here is that for my second year, I said 1,282, right, multiplied by 5.47%. All right.
Yeah,
Don't.
it's correct.
Aha. So this part is also constant. Our 300. 300 was annuity. That was what we paid in each year. All right. So this. Then the third year as well, 1,052.6. This is how we got the 1,056. That is this plus this minus this 300 will give me this. So this closing balance is my opening balance for year 3. Closing balance for year 2 is the opening balance for year 3. 15 minutes to go, I know it. Right? So opening balance for year 3 times 5.72% will also give me this. 57.55 minus 300 will give me this. Right? Then the fourth year also will give me this, like that, up to the end. What do we have, please? So we are having we are having 0.12. That's 120 naira. Ba? Should I call it 120 naira? Hello? So 120 naira. All right. Now this 120 naira, we need to take it out completely. Instead, what do we just do? So we can assume that the 120 naira came from approximation here, right? So that 120 naira, we can just add it to this 0.55 plus whatever I got here plus 0.12. So let me take away. I just use that to take away the 1.2 naira, which is 120 naira. 0.12 times 1,000 is 120 naira. So that can be used said to be insignificant. 120 naira from 1.5 million naira. All right. So that is that. Now we have it to be this. Our cost is now this, right? Hello.
Yes.
Now the P&L account for the first year, this 82.25 is what is going to our P&L account as the expense, as the interest rate, right? Which is
Yeah.
our finance cost. Abi,
Yes.
please, are we all together?
We are.
Yes, sir, we are together, sir.
So
We,
it means that in 2018, right?
yes.
Don't forget we have debited 1,500 as the right to use the asset and 1,005 as the liability. In that same year, we have our depreciation to be 250. The 250 will be expensed, right, for
Yes.
the year. Then apart from the 250, we also have this interest rate to be expensed. Now the interest rate is part of our liability, right? So we are to
Yeah.
debit the interest rate as a current liability now for 2018,
Yeah.
right? And credit our lease obligation of that same figure. Then also in that same year, we are paying 300,000 every year. So that 300,000 we are paying as well. What do we do to it? The installment. What do we do to it? Eh? If you are paying the installment, what are we doing? We are debiting it. We are paying part of our liability now, right? So that means we debit the liability again. Am I right, please? Hello?
You are right.
So we debit the liability to reduce our liability, right?
Yes.
And then credit our, what are we crediting now? Eh?
Operating expensive.
Crediting operating expenses. When you credit operating expenses, what does it mean?
In an income.
It means an income. So is 300,000 an income?
No, it's an expenses.
So what is not an expense? Oh, it's a payment of liability,
Okay.
right? So yes, one way is that you can debit your liability and credit your bank.
Okay. Or
It's a
cash.
bank payment now, Abi.
Yeah.
So what we are saying so far is this. For subsequent recognition now, right? Now don't forget we are to adjust our lease, right? How much do we recognize in our lease before? I hope we are there.
Yeah. It's 1.5. I mean, 1.5 million.
Yeah, this is what we have before, right? Now, also don't forget, how much did we charge to our P&L account?
We charge the depreciation.
250.
We have charged depreciation of 250, right? But in
Yeah.
actual sense, what we are taking to our uh, liability accounts now, I mean, our P&L accounts now in total, right? Now, this 300 is what should go into the account in total instead of this 250. All right.
Okay.
So now what we can do is that we can leave the depreciation as it is. Why the next thing we have to do is that when we are debiting our lease obligation, that is to reduce our liability, we can also credit our P&L account so that to show the difference between that 250 and the 300. Do we understand that?
Yes.
Okay. So that means, let me take this debit and credit. So we have to debit. The first thing we have to debit is we have to adjust for our uh, interest rate, sorry, implicit interest rate, which is the expense, right? Now, for the expenses now, right? Interest for 2018. Or let me do it like a normal journal entry. So we debit our interest expense account, right? P&L account as our finance cost. How much is the P&L account? How much? 82,050.
82,050.
Now let's check this our total expense. What's this our total expense? 300. So you can see the implicit rate is 300, right? That implicit rate is also what was going on every year. So the total implicit rate is 300, right? Okay, let's leave that. That's not where we're actually going to. I just added that. Now, the P&L is 82.05, right? 82.05, and then we credit what? What do we credit again, please? Our lease obligation,
This obligation.
right? Lease obligation is also okay. So let me also put it here. So 1,500, 1,500. So let's leave it that way. Then this one is also a 2.05, and that is being interest, right? Being interest expense, being finance cost
2018.
for 2018, right? So that's the journal entry. Then also for our lease obligation now, right? We also debit what do we have it now? Our installment 300. right? So the 300 is to reduce our lease obligation, right? 300,000, and then we credit what again? The operating expenses, right? P&L account. The P&L account with 300,000. So, and that will be to reverse, being reversal of amounts charged to P&L. Okay, so that is that. Any other thing on this list that we have not mentioned? Any other thing on the list that we have not mentioned? We have our initial measurement, we have our subsequent measurement, right? Then what else do we have? What's the presentation? What's the presentation? This is how we recognize it in our balance sheet, right?
Yeah,
Presentation is
the
that we present this one as an asset and this one as a liability,
liability, yes.
right? And what are the disclosures? Disclosure is that you have to tell us the implicit rate. They gave us the implicit rate already, right? You have to tell us your present value, right? You have to tell us your depreciation and the method
Depreciation.
of depreciation, right? What else? What else? What else? What else? What else? What else? I think that's all. No, there is more. What else do we do now? Is there any other thing? Well, at least you have your point in your
That we recognize in the financial statement,
yes,
like the one we recognize under non-current liability and the current liability.
yes, and we've recognized that. Okay, so which one do we recognize under non-current liability now? Everything from here, these two, addition of these two will be under non-current
Non-current
liability
liability for
because it
the
is
year.
after 1 year,
Yes.
right? Our current liability for the year will
We,
reduce, right?
we recognize the we recognize the closing balancing of the first year, difference between the close balance of the first year and second year under the current, while the what we have in the second year will be recognized under non-current liability, the value.
Yes, yes, you're right. Any other thing? So you have to classify your liability to current liability and the non-current liability, right?
Yes.
Now this closing balance is a current liability because you have to pay it at the end of the first year. Am I right?
Yes.
Okay. Any other thing, please? Okay, in the absence of that, I think that's all for our
Please,
list.
hello,
Yes,
sir.
sir. Yes, sir.
If this thing is in advance, when we are calculate present price, we will deduct that 300,000 naira before we calculate the annuity, before we calculate the value.
Yes. Before we calculate the interest, we deduct the installment.
Okay. I mean, when we are calculating the present value, are we going to deduct that 300,000 naira first before we? Okay, we minus the one out of that 6 years before you calculate the annuity
Before we
instead of
get the
calculating.
present value, right?
Yeah.
And don't forget, 300,000 would have been paid, so 300,000 might not be part of it.
Okay.
What I'm saying is that annuity, which is that year, which is 6 years, if it is paying in advance,
If it is
Yeah.
paid
we
in
now deduct,
advance, it will be 5
we
years
now deduct.
because we would
Yes,
have
okay,
paid the 300,000 in year zero.
that's what I'm
But this
thinking.
case now, it is from year one, since
Okay.
it is in arrears.
Yes.
So meaning that interest in place will come after the installment.
Impl- interest implicit, yes, we come after the installment, of course.
Yes.
Thank you.
Any other thing?
Please, the worksheet after class, please.
Sorry?
I said the worksheet. Kindly assist to send the worksheet. Both this one and the previous one just printed for the group account.
Okay. Any other thing?
Sorry, sir.
Go ahead, sir.
If I want to revisit this lecture, how can I get it, sir?
The online, it will be online, to be posted online.
Okay. Is it okay? Into the YouTube?
Yes.
Okay, thank you. Thank you. So I can also get the previous lecture on it too.
Yes, sir.
Okay, thank you.
Shall we proceed now? Should we go into question B, or we continue in our next class?
Enzo Maresca.
There's an element of needing to move.
Should we go into question B or continue in our next class? Hello? We have 2 minutes to decide that. This session will end. Now let's take our what's it called? Our workings, right? Since we have a consolidated account there, let's take our workings for the consolidated account before we call it a day, right? So we'll not spend too much time on that. That means we'll have to come back for another session. So we are coming back for another session immediately. There is no need for any minutes break. Shall we? Shall we proceed, please? No, please. To our what's it called? Our workings. Okay. Let's do the workings for our consolidated financial statement. And once we are done with that, we can now decide on what's we can continue from there in our next class. But let's have our reports, right? Let's do our working so that in our next class we just impute all of them. Now, right? The consolidated accounts.
But they ask us to prepare the consolidated profit and loss account before the financial statement.
Yes. We just want to do all our questions on ground. We want to have them now.
Okay.
Shall we?
Yes.
Okay. So let's look at the group structure. The reason for us to do it, not because we can't do our accounts like that, but we'll need it for our income statement as well, right? For instance, now we might have some inventory that will affect us, that will affect our financial position, right? We might have inventory, interrelated transactions, intercompany transactions, and all of that, right? So let's just do the workings, and in our next class, we can just fix them. All right. Now, so what do we have here? What's the group structure? On the 1st of January 2014, Bola acquired 9 million ordinary shares in Tanko for 23,250,000 when the reserves were at 3 million naira. Right? Okay. Now we bought 9 million shares. How many shares was in Tanko?
12 million share.
12 million.
Yes,
Where is our equity? Yeah, equity is Tanko is the second one now, right? Tanko had 12 million shares and we bought 9 million, 1 naira each. If you're asking me how, 12 million naira divided by 1 naira will give us 12 million shares. So 12 million, I mean, we bought 9 out of 12, right? 9 over 12 is what? Times 100. That's 3 over 4.
25%.
75%, right? So which means for our group structure, we have it to be 75% for Tanko, right? And okay, let's leave Tanko. Then for Eze, who is Eze? A new asset of fair value of this one, blah, 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 blah. Let's leave this one. This one is the lease. Now, Bola Limited, intangible asset software, position, Bola, then also at the date of acquisition, Tanko. This is for Eze. In 2017, this was purchased in 2014. Now, this one is 2017. Bola acquired 2.25 million ordinary shares in Eze, right? What's the value of shares? What's the unit of shares? 7 million. 7.5 million. And we purchased 2.25. 2,250 divided by 7,500. We give us what?
30%.
30%. What does that make us?
Is an associate.
So we have a subsidiary and an associate, right? Okay. If that is the case, now, so that means my Excel sheet. Group structure. Let me put my workings here. Workings 1. For the group structure, yeah, what do we have as our group structure now? Yes, we have Bolahon. The full name is Bolahon. Bolahon to Tanko. But Bola is what the question gave us. Bola to Tanko is how many percent? I wrote tank.
75%.
We have it to be 75%. I think I can move all of these to this place. %75%. Then also we have Bolahon to Eze, right?
30%.
30%. I believe we understand how we got that. We don't need to be explaining that now, right? Okay, that's our group structure. Now, then the next one is the fair value of the assets. How do we value our NCI? Yes, how do we value our NCI? Is ask I'm asking you. Hello? In the question now, what does the question say about our NCI? Carrying amount is this. The same fair value at the date. This one. Components. How do we value our NCI? When we are not given, we can use net asset at the date of acquisition, right?
Yes, sir.
Do we have the group policy here? This is goodwill being impaired. Receivables here. Then this information component, produce components, margin. This is sales. So this is intercompany transaction. Sorry,
There's no any police there.
they did not give us the policy, right? Now,
Yes, sir.
if they had given us the policy, whether they gave us or not, the only thing that will make us change it is if the NCI value is given to us, right? And if NCI value is not given to us, definitely that means we have to use net assets at the date of acquisition, right?
Yes, sir.
Okay. So NCI at the date of acquisition now, I mean net asset at the date of acquisition. So what will be our net asset at the date of acquisition? Yes, how do we do that? I think we have a table here.
We calculate
Can
it.
I steal from here? I think I can steal from here. Please let me steal this one.
Stealing is not allowed, sir.
I'm sorry. I cannot continue to write everything again. The thing can be exhausting sometimes. Okay, so we have our net asset, right, at the date of acquisition. So for the net asset at the date of acquisition, right, this is my working stool. Now we have, what do we call this one now? Bola to Tanko, right? And we also have Bola to Eze.
The board is not showing.
Can anyone see my screen? Can anyone see my screen, please?
Yes, I can.
Yes,
I can
sir.
see it.
Okay, I guess that's your network, sir. Can you please confirm your network?
Okay, sir. Okay. It's
Yes,
showing
sir.
now.
Okay. If I'm stealing this one correctly. Don't let me make mistake. Okay. Now, what do we have in the question? What's the structure of the question? We have our net asset. What will be the net asset? We have ordinary share capital, right?
Yes.
At the date of acquisition. Now, let's leave the ordinary share capital. Let's go into what? At the date of acquisition. Yes. Ordinary share at the date of acquisition and at the date of consolidation will always be the same thing. Abi?
Yes, sir.
Aha. So our
The
ordinary
one
share at the date of acquisition for this one, I think 12,000. I remember that 12,000 very well. 12,000 and 7,500, right? 12,000, 12,000, then 7,500, 7,500, right? Do they have any share premium? No, but they have reserve. I mean,
yes, sir.
they have a reserve of 10,000 and 350, right? So
Yes, sir.
reserve, that means I don't need this.
Hello, sir. Please, can I ask a question, please?
Go ahead, sir.
I noticed the last group account we solved, we didn't capture the reserve of one of the subsidiaries. I don't know. I don't know if it's
This
inclusive as in both equity and reserve that is only captured of that of the parents. I thought it's only equity.
this one. Are you talking about this line, sir?
No, the last one we solved earlier, I think the first one we solved today
Today.
for OMI and the rest,
And
yes.
this is Omi and the
We
rest.
didn't capture the reserve. Yes, we didn't capture the reserve of one of the subsidiaries in the consolidated financial statement. So I don't know if it's the same principle we applied for equity of the parents alone that we also apply on reserve as well. I don't know if you get my
I don't
question.
understand.
So now, in preparing consolidated financial statement, when you come to equity,
Okay,
shall we
you
only
mean in the
capture that of the
consolidated
parents
reserve,
alone?
Abby? The
Yes,
consolidated,
yes, sir.
no,
I know.
now. You will not take reserve of subsidiary. Everything that has to do with equity, you will not take that of the subsidiary.
Okay, okay, okay,
You will not take that of the subsidiary.
okay. All right.
Shall we proceed?
Yes, please.
Okay.
Yes, sir.
Okay. So we have our reserve in the question. They told us that the reserve at the date of consolidation is 10,350 and 2,400, Abby. At the date of consolidation, 10,350, 2,400. So what was the reserve at the date of acquisition? When the reserve here was 3
3,000
million naira.
for Tanko.
3,000 for the
And
first one. And the second one is,
3 million.
and 3 million is 3,000. When did we purchase this? And this one
One
is
million 350
1,350,000,
for
3
8
million and 1,350,000, right? So we have this one to be 3,000 and this is 1,350, right? I know I did a post acquisition profit here before. Okay. Okay. Yes, what else do we have? Now, in the information, they told us that,
I cannot hear anything. No, it's just me.
I guess so. Can you hear me now?
Yes.
Madam, can you hear us?
Okay, yeah, it's better now. Thank you.
Okay. Shall we proceed now? Okay, so we have this one, the reserve,
Yes,
there
sir.
is no additional. Now, a new asset of fair value of 1.5 million was purchased, right? Was acquired during the year, and then that acquisition, uh, this one is during the year now. This is not at the date of acquisition. Information 2 is gone. Now, Gola Limited had an intangible asset of 750 in software in a financial position. They believe that the software had no recoverable value. Okay, now this is it. The directors of Gola Limited believe that the software will have no recoverable value at the date of acquisition, and Tanko Limited wrote it off shortly after its acquisition. Now that means it's not even in our account at all, Abby. Right? They wrote it off. Now, for the other person, at the date of acquisition, okay, I think there's initial information here. Are we there, please? Sorry.
Yes.
Okay. Now, hold on a second. Okay, now, at the date of acquisition of Tanko Limited, the carrying amount of its PPE considered to have a remaining life of 10 years was 5,650,000, lower than its fair value. That means the fair value recognized for that asset was overestimated. Abi,
Yes.
it has been overstated.
It will deducted from the next service.
Sorry, what do you say, please?
I think we are going to deduct that value from the next asset of the company.
Yes. So this value of 5,625,000 is in the account and is too much. So what do? We need to remove that 5,625,000. That's number one,
And
right?
calculate it and calculate the depreciation on it.
And there will be depreciation on it as well, right? So the fair
Yes,
value
sir.
the fair value adjustments now. Now that means this 5,625,000 is part of the
Not to
at the date of we have it at the date
calculate
of
the depreciation
consolidation now,
again.
Abi, eh? Are we there? Hello, shall we proceed? Shall we proceed, please? Huh? Hello, is anyone there?
Yes,
Hello?
sir, we are with you. Yes, sir,
Okay.
I'm with you. I'm with you,
Okay,
sir.
I can't hear anybody, that's why. Now, at the date of acquisition, the carrying amount considered to have a remaining life of 10 years was 5,000 lower. It was not overstated though. the fair value is lower. That is, if the fair value was 10,000, we recorded 5,000. Hello?
Hi.
Don't let us mix it.
Don't let us mix it.
The equipment is 5,625 lower than its fair value, which means we have to bring the remaining 5,625 back to it to make it what it is meant to be. Right? They understated the assets. Hello? Who is that person?
Hi. Hi.
And the person is not even talking to us. Let me see.
It's Mr. Olarewaju. Maybe he's not aware that his background is noisy.
Mr. Olarewaju, please. Oh.
Sorry.
Okay. Now, the asset was understated by 5,625. Right? So 5,625, we need to bring it back into the asset account. Right? Now, 5,625 is not there at the date of acquisition. It has been understated since the date of acquisition. So we need to bring it back now. Right? Because it was not recorded. Right? There is no retain earning in this question now. Abi? Do they have retain earning in the question before I rub it off? Is there any retain earnings here? Equity, reserve. There is no retained earnings now. Abi? We only have reserve. Okay, that means I can use it. So I can use the fair value adjustment. Now the asset has to be adjusted, which is 5,625. Abi? In the book of Tanko, we don't have it here. Right? Now this 5,625, when did we purchase Tanko? 2014. When is our consolidated account? 2018. How many years is that?
I think it's 5 years.
5? Are you
But
sure?
yeah,
Are you sure?
yeah. 14,
Yeah,
15,
it's
16,
5 years.
17, 18, 18.
Eh?
It's 5 years. Huh? 14
It's 5 years.
January.
January. So which means December 2014, 15, 16, 17, and 18. Right? So our depreciation for the year. Hello? Hello, are we there?
Yes,
Yes,
sir.
we are.
So our depreciation for the year, our depreciation for the whole period will be for 5 years. Right? Now, if you are doing that, you are including the depreciation for the year into it. How about the depreciation for the year goes into the income statement? And then we recognize the depreciation for the last 4 years. We deduct the depreciation for the last 4 years. And then the depreciation for this year, we go into the income statement. Do you understand? Hello, are we together?
Hello, sir.
Yes, sir.
Please come again for the
Okay.
posting.
Now, the asset is 5,625,000. We purchased it in January 2014, Abi. At the date of acquisition, it
Yes,
was
sir.
there. Right? Now, since the date of acquisition up to this date, 2018, is 5 years. Right? Now,
Yes, sir.
the depreciation for this year, we can still recognize the depreciation for this year in our income statement. Right?
Okay, sir.
Are we there, please?
Yes, sir.
Sorry, too, sir.
Uh-huh. Now, we can do the depreciation for this year in the income statement. We can put it in the income statement so that that one is expensed for the year. While we adjust our balance sheet, don't forget what we are doing in our balance sheet is that we want to ensure that the value is is included. The depreciation for the last 4 years is included before we now do the net asset. So the next depreciation for the year will be in our balance sheet. Does that make a sense? Hello?
Exactly.
We don't understand what I'm saying, but do we understand what I'm saying? So, okay, now let's look at the non-current liability, non-current assets in the question. What are the non-current assets? The PPE, what do we have on it? Yes, what do we have now? So, for instance, now if we are doing 5625 for 10 years, it will be 562.5, right? Hello.
Hi.
Hello, sir.
It will be 562.5, Abby.
Yes.
Okay. Now,
Yes.
that 562.5, the 562.5 that we have is depreciation for the year. Now, depreciation for 4 years is from 2014 to 2018. 2017, right? Now, which means if we do that, the remaining 1 year depreciation for 2018 itself, we can put it as part of our depreciation. Depreciation for the year in our income statement.
Yes. Yes.
Do you understand me?
Yes.
So we can do that depreciation for the year of 562.5, that is 55,625 divided by 10. 562.5 can go into the income statement. That one is for the year. So if I take that one to income statement for the year, the remaining 4 years ago, I can put it in the balance sheet to reduce the value. Do we understand? Do we understand, please?
Hello, sir. Is it
Yes, sir.
the remaining 4 years that will go to the balance sheet of 5 years depreciation?
4 years we
An
go straight
accumulated
into the
depreciation?
balance sheet. The one
Okay.
for 2018, we are still in 2018. The depreciation from 2018 should go to income statement before we now reduce it in our balance sheet again under PPE.
Okay. 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 Okay.
Do we understand that now? Do we understand, please?
Yeah. To clarify
Yes.
my doubts, sir, are you with me, sir?
Yes, sir.
As in the balance sheet now for 2018, the accumulated depreciation, is it going to be for 5 years?
For 2018. Now,
Yes, as at
if
2018.
so, this is what I'm doing. I want to recognize 4 years of that account in our balance sheet first. In my net assets at the date of consolidation. Right? Now, when I get to balance sheet itself, that remaining depreciation, I will also remove it. Now, don't forget, the depreciation for that 4 years too will leave the balance sheet. The one for the current year will go into the income statement. Ordinarily, if not because it was forgotten, depreciation for the year should be in the income statement. So since we are still in 2018, depreciation for 2018 should be in income statement as 5,000 or 562.5. You don't understand. So, okay, I understand what all of you are saying, that since it is 5 years, the whole depreciation should just go straight to the net asset at the date of consolidation, right? Is that not what everyone is suggesting? That's what you are thinking, right?
Yes, that's what I'm thinking.
Okay. So, yes, I understand that too. Okay. But in actual sense, the depreciation for the year should go into the income statement. That one will not show in our net asset. There is no income state, there is no in the net asset, there is nothing like non-current assets there. So we can adjust that in our balance sheet when we are doing the non-current asset for the year. You still don't understand? Okay, so now this is what we'll do. Remind me when we are solving this question when we continue this question, when we are doing the balance sheet in our next class, okay?
Yeah, I think maybe when you apply figures, maybe probably that's when we'll understand it better.
So this is what I'm
Maybe you should
saying.
solve it practical.
So what I'm saying in essence is this, right? The fair value adjustment is this, right? Now, I can remove depreciation on that fair value adjustment. Depreciation on fair value adjustment to be 5,000 5,625 abi divided by 10 years times 4 years.
2,250. 2,250.
2,250. Now my 2,250 can be removed from this 5,625, right? Why depreciation for the year? That means this fair value adjustment now, I have not considered the depreciation for the year. It was the depreciation, the asset itself. When was the asset purchased? At the date of acquisition, the carrying amount, and it was purchased in January 2014.
14.
So we have December 2014 depreciation, 15, 16, 17, and 18 to make it 5 years, right? Am I right? But I'm saying that the depreciation for 2018 itself, I am not doing it now as part of my net asset. I am putting that one in depreciation for the year. When we get to the balance sheet itself, I will remove the depreciation for the year in the balance sheet and add that depreciation for the year in my income statement. Do we understand that now? So that's what I'm saying. No worry. Just remind, I won't even forget. When we get to our next class, we'll discuss that as well. All right? Are we there?
Yes, sir. We are with you.
Yes, sir.
Okay. Now, what else do we have? Is there any other thing? No. Now, this is the net asset at the date of acquisition. Is that our net asset at the date of acquisition? Now, this 5,625 is also there at the date of acquisition. The carrying amount of the PPE considered to have a minimum. So this 5,625 is also there at the date of acquisition, right? 5,625. Am I right, sir?
Yes, sir.
Hello? Are we together, please?
Yes, sir. I'm
Yes,
with
sir.
you, sir.
Now, the 5,625 is there at the date of acquisition, right? And also at the date of consolidation, right?
Yes, sir.
Okay,
Yes, sir.
so let's look at if we have any other information. This intangible assets, information 3. Bola Limited had an intangible asset of 750 for software in its financial position, right? Now, the directors of Bola Limited believe that the software will have no recoverable value at the date of acquisition, and Tanko Limited wrote it off. Are we there, please?
Yes, sir.
So
Yes,
Tanko
sir.
Limited wrote off this 750 at the date of acquisition, right? Hello, do we understand what we are saying?
Hi. We are with you, sir.
So that means we need to
Yes, sir.
remove this 750 as well from our date of acquisition. Am I right? Because Tanko Limited had removed it. So what do we have? That means I have one more thing to put here.
But sir, why did Tanko Limited removed it?
The reason is in the question. The directors of Bola Limited believe that the software will have no recoverable value at all. It is not useful.
Okay,
It is an
okay,
intangible
okay,
asset, but we can't recover anything from it, even if we want to sell it.
okay, okay.
Right?
Yes, sir.
Aha. So that is software. Software written off. How much is that, please? At the date of acquisition, right?
750.
Uh-huh. That's 750. Any other thing? But we don't have it at the date of consolidation, are we? Eh?
So it's not going to appear at the date of consolidation.
It will not appear at the date of consolidation. It's
Yes.
not in our account at all at the date of consolidation.
Okay, okay.
Right? We've written it off since 2014. So what is it doing in our account in 2018? Do we understand, please?
Yes, sir, we do. I do.
Okay.
Yes, sir.
Then what else do we have? Any other thing?
Yes, sir. Yes.
Yeah, I
Service
think
pay.
unrealized profits. I don't know who
Okay.
is selling, whether it is subsidiary or parent. Maybe we should look at the additional information.
Okay. For the unrealized
If it's
profits, right?
a subsidiary that is selling.
Hello.
Hi.
Unrealized profit. What year was that? I mean, what's additional? Okay. A component used by Tanko Limited and Eze is
Six.
produced by Bola and it sells its component margin. No, Bola is the one selling. Parent is the one selling, not subsidiary.
Okay, okay.
Mm, produced by Bola and it sells this component at a margin of this. They were sold to Tanko. So parent is the one selling. Any other additional information that we have not used? There has been no impairment for AZ Limited. However, impairment is conducted by for goodwill. That's for goodwill. Cash and cash equivalent. We'll do that as well. All right. So that's it. Any other thing? I guess none. Right. So now we have our net asset to be this at the date of acquisition. Right. Depreciation on fair value adjustment. Is it 250?
No, it's 2,250.
2,250.
Okay, 2,250. Okay, then we have 25,000 here, 725, right? We have post acquisition profits to be this, right? Now, this post acquisition profit, let's leave that. Oh, we might not even use that for our goodwill, depending on how the question is structured. Now, what else do we have, please? That's our net asset. Then the next one we have is our goodwill, right? Right? Let me see if I can still
Yes,
see it
sir.
from here. Goodwill. What do we have for our goodwill? What do we have for our goodwill?
Cost of
How do we prepare our goodwill?
cost of acquisition.
Cost of
Add
what?
the NCI at acquisition. Cost of acquisition. We add the NCI at acquisition dates and deduct this from NCI.
Okay. So for our goodwill, calculation of goodwill. Calculation of goodwill. Yes, for our goodwill, we have two, right? We have for Tanko, we have for AZ. I'm looking for where to steal it. I can't do the two of them. Okay. I'll need two, not three. Goodwill for Tanko and AZ. Are we together, please? Hello?
Hello, sir.
Okay. Tanko and Eze. Right? So Tanko, then Eze is here. Now, what will be our goodwill? We have our Naira sign.
Sorry, sir. Please, can I ask a question, please?
Go ahead, sir.
Yeah, my question is, should we also calculate goodwill for Eze since our investment in him is an associate?
Do we have any goodwill? Can we have even a goodwill there? No, we can't. No, we cannot have in Eze. It's an associate. Thank you. We can't have it. Yeah, Eze is an associate. Thank you, sir. You see
Yes.
why you should be there with me now? Me, I've forgotten the group structure. Our group structure there is 30%, right? So Eze is an associate. Now, what's the cost of investment? Consideration. Purchase consideration. What was our purchase consideration, please? How much did we pay to Tanko?
23,250,000.
23,250.
So Tango 23,250,000.
Right? Then what else do we have? NCI. Add NCI at the date of acquisition. Right? Are we there? Hello? NCI at acquisition. I can just decide to use one of these safe. Yes, what's the NCI at acquisition? 19,875 times what is the NCI? How many percent do we have?
25%.
25%.
So 19,875 times 25%.
4,960.
960 what?
4,969.
4,969. Okay.
Yes.
Then less net asset at acquisition. And that's minus 19,875. Abi?
Yes, sir.
Am I right? Okay.
Yes, sir.
What does that give us?
8,344.
8,344. Right? Now, don't forget this our 5,625 as well. Right? The fair value adjustment. Are we there?
Yes, sir.
The fair value adjustment now, what's our depreciation on it? We have the depreciation to be 2,250. Right? Now, so this is it. This 2,250 is the depreciation, right? And also the 2,250 is the impairment of that asset in 10 years, right? Now, don't forget, as at the date of this net asset at the date of acquisition, up to this date that we are preparing our, what's it called? Our date of consolidation, right? We've not included the depreciation there. All right. So if you are looking at the fair value of, if you are looking at the goodwill now, we need to remove that element of that 2,250 depreciation of fair value adjustment. All right. Depreciation of fair value adjustment. Okay. Which is let's call it impairment, because the question will now be, how does depreciation enter goodwill, right? So we have 2,250, all right, and that means our goodwill will now reduce to, what do we have, please?
6,094.
6,094, 6094.
Yes.
Okay, so the 6094 is our goodwill. We'll end this class in the next 15 minutes. So 6094 is our goodwill. Okay, now that is that. Shall we proceed? Hmm? Now this thing can be done in two. This 6094, this
Sir,
2000, yes, I'm listening, sir.
I think that information number 8,
8.
there has been no impairment for AC Limited. However, the impairment tested
Information 8. Okay, there has been no impairment for AZ. However, the impairment test conducted on Tanko's goodwill showed that the goodwill is being impaired by 10% per annum on a straight line basis. Okay, so the impairment test conducted on Tanko's goodwill showed that goodwill is being impaired by 10% on straight line method. So what's the goodwill? Are you saying this 8,344 is what will go down by 10 years? Do you understand what I'm saying, sir? Hello.
Hi. Hi,
It
sir.
says
Hi.
that there has been no impairment for AZ. Impairment conducted on Tankos Limited showed that goodwill is being impaired by 10% per annum on a straight line method. So the impairment of our goodwill now, 10%, right, per annum. And what will that give us? What does that information represent, please?
I think we'll have to calculate 10% of 8344 to serve as our impairment figure, if I'm correct.
Okay. So let's look at it this way. Our impairment figure is H34. Yes, ordinarily before impairment we have goodwill to be H344, right? Are we there, please? Hello. Now, another thing is this. You see this 2,250? You know you can remove it out of your net asset at the date of acquisition. Do you know that? Hello.
Was
Hi.
about
Hi.
asking that why didn't we deduct the 2,250 at acquisition, since the fair value adjustment is also at acquisition and the depreciation is actually charged on the fair value adjustment? So why can't it be at acquisition?
We did
Why
not
was it
charge the
as
depreciation at acquisition. We did not even record
like
it at acquisition. We've not recorded it in our account, but it has always been there from the date of acquisition.
that's why I'm saying why? Why didn't we charge it? Is the question. Like, is there a reason for it why we didn't charge it
Charge what?
at
The
acquisition?
depreciation.
Yes.
So that's the information given to us. They did not charge it. Why was not given to us?
Okay.
Right? Now, just like I was saying, now this 2,250, remember I told you that it can be our depreciation. This depreciation can be in our financial position, right? The PPE 2,250 will be there. Do you understand that?
Yes. Yes.
Hmm? This
Yes.
2,250 will go into our financial position. All right. Now,
Yes.
in our financial position as well, the question says that our goodwill is to impair. Okay, let's follow the information first. If this is our goodwill before impairment, right? Now, after impairment, they said that let's try it at 10%. Impairment at 10%. What would that give us? 834, right? 834.4 will be 834. Am I right? So that means we'll have 7,510, 7,510. So let's leave this goodwill as our goodwill after impairment. Now, these are goodwill after impairment. This 734, 834 self that we are doing, our goodwill has been impairing for the last how many years now? Hello? If the goodwill
Hi.
is impairing, the goodwill, this one is 834 for this year, right?
Yes.
834 for this year, right?
Yes.
Now, 834 for
Yes.
this year, don't forget, we are preparing this goodwill at after 5 years, in the 5th year. Am I right? So the goodwill impairment was in 2014, 15, 16, 17, 18. That means this 834 is not what we go there. It will be for the whole 5 years we are recording now. After all, they've not been recording it in the account. Am I right?
Yes, you are right. You are right.
So our goodwill now will be times 5 years. And what does that give us? So it will be 834 times 5. H 34.4 times 5. That will give us 4172. Abi? I don't know
Yes.
if
Yes,
anyone
sir.
4172.
understands me.
4172.
Right? 4172 impairment for the year. That means I'm doing the impairment for the year as well. Am I right, please? Hello?
Yes, I
Hi.
will have it.
Okay, so we'll revisit this particular part in our next class when we get to our consolidated account. All right, let's just start it like this. Is there any other thing you want us to treat before we go into this account?
Yes, sir. Please. How did we get to know the exact way of valuing our net assets?
So two things. Is either you value it at net asset at the date of acquisition,
João Pedro, who was sent
or
off here last season, has
fair value
been
is given to
substituted
you,
off here.
right? Is either at the date of acquisition, net asset at the date of acquisition, or fair value. Now, the question will tell you, the question can give you the fair value of the NCI. If the question gives you the fair value of the NCI, there will be a note that will say that the company currently value their NCI at a fair value. That means you are not using net assets. You are using fair value. Do you understand, sir? Hello?
Hello, sir.
If the question does not tell you that you have to use fair value, then you are automatically using net assets. All right? So you're automatically using net asset. Is either you are using fair value or net
Okay.
asset. Right? So that's that. Any other question, please? Hello?
Hello, sir.
Okay, let's continue from here in our next class. We have just 7 minutes to end the class as well. So let's continue from here in our next class. Shall we proceed, please?
Yes, sir.
Yes, sir.
Yes, sir.
Okay. The next we have is our receivable,
Trade
right?
receivable.
So what do we
Yes.
have on receivable? 960, 420,
960.
196, right?
Yes.
So
And do we have any other thing under receivable?
Yes.
What's that?
Information 7.
Information
The
7.
the pension
Yeah,
benefit tariff
the parent
to
company
be
had contributed to the tune of this, right? Now, during
yes.
the year, OMI PLC decided to establish a defined benefit scheme for employees of the parent company and contributed cash to it to the tune of 400 million for their employees, right? So we have 400 million contributed. Now this thing, this one now has been included in the, what do we call
The
it? The
the
only
trade
entry
receivable.
in the financial statement made to this is in respect of cash contribution, which has been included in OMI PLC's trade receivables, right? So this 400 million now we need to remove it from the trade receivables, all right? So what do we have for our receivables? What do we call the figures again? We have
1,000.
960, 420, 196, right? 960
Yes.
plus 420 plus 196, right? Minus that
minus
400. And that gives us what, please?
1,170 1,176.
1176. The next one
Yes.
we have is cash
Cash and cash
and
cash and
cash
equivalent.
cash.
equivalent. Do you have any information on that cash and cash equivalent?
Yes.
No,
Eh?
no, sir.
No, no.
No. Okay.
No.
Okay. Cash and cash equivalent. So what's our cash and cash equivalent now?
880.
880.
360, 200, and 320.
So
360 plus 200 and 320. I mean,
Yes.
that
so
gives us 880. Yes. Okay, I think that's all we have. That was the last asset. That's the last current asset in the question. Yes, what do we have? In total, we have it to be
12,000.
3976, right? So our total assets, do we have total asset here? Yes, the question also gave us total asset. So we have to do our total asset as well. So total asset will be this plus this, right? So this is our total asset.
Sir.
Yes, sir.
Hello? Is it necessary that as the way the question is stated, we should state it when we are solving the question?
Yes,
For example,
please.
under the total current asset, the first of all, write total current asset, the total before the total asset.
I don't understand.
Under that current asset, the first
Uh,
of all add all current asset together, which is total current asset.
uh-huh. And then we now have
The
total assets.
total, yes.
Yes.
What, what I'm saying is that is it necessary to be doing like that when someone
It
is
is,
solving the question?
yes, it is better for you to solve it in that same manner the question has brought it.
Okay, sir. Thank
Yes, please. Okay, so the next one we have uh is what again? We go into our capital, right?
you. Yes.
So we have capital and liabilities. Same way the question has given to equity and liability.
The ability.
Equities and liabilities. So what do we have there?
We have
Equity,
share capital.
Okay,
share
under
capital,
we
and
have
equity.
equity, share capital. So it's even equity, not equities. So we have equity. For equity, what do we have? We have share capital.
Share capital
6,000.
How much?
6,000.
1,000.
That's the share
Parent
capital.
only.
Hello. That's the share capital of the parent only, right?
Yes.
Yes, sir.
Okay, good. Share capital is 6,000. Yes, what else do we have?
Share premium
Share
Share
premium.
premium,
1,
1,200.
2.
which is for
1,
the
2.
parent only as well, right?
1, 2. Yes, sir.
What else do we have?
Retain earnings.
We don't have any
Retain
revaluation reserve,
earning.
right? Because the parent does not have. Then we have retained earnings. We have revaluation. Okay, revaluation reserve. After that, we have retained earnings, right? So let's bring out our retained earnings. I believe we've solved that one too. What's the retained earnings we have? Total retained
It's
earnings
2,000. Yeah,
2346,
2,000.
right?
2,000.
2345. Should we go decimal points?
No, let's round up, sir.
Since others
2,340.
are not there, right? So 2346. Retained earnings is 2346, which is working what? Working 5. All right? Are we there?
Yes.
Yeah.
Yes, sir.
Yeah. Shall we proceed, please?
Yes.
Okay. Now, after the retained earnings, nothing else, right? So what will be in the question? That's it. Now, after that, of course, we should have our NCI given to us, right? What does this one give us first? Right? Hello.
Yes, I will with you, sir.
Okay. So what do we have here? The next one, like I said, is this is our total equity, right?
Yes, sir.
This is our equity. Then we have our NCI. And what's our
Non-controlling.
NCI? We've prepared our NCI as well, right? That's working
Yes, sir.
4. NCI is 1058.4, right? So we can
Mm,
also round that off to be
thank
1058.
you.
I mean, that's
Yes, sir.
working 4. Next, what do we have? After NCI,
No,
what do we do next? We go into our
no.
NCL, non-current liabilities, right? Hello, are we there?
Yes, yes, sir.
Yes,
Yes,
sir.
sir.
We are there. We are with you.
Okay, so what's our non-current liabilities now? For the non-current
540.
liabilities, we have 540, 100, and 80,
180.
right? Do we have any additional information to that? No, I can't remember
No,
Mm.
something like that.
none, sir.
Whoa, this is my. Okay, so for our non-current liabilities, yeah, what do we have it to be?
720.
540,
540.
180.
That's 180.
540, 100,
720.
180.
and 80. That gives us 720.
720.
Abi,
Yes.
then
Yes,
what
sir.
else do we have in our non-current liability? We have current
Pension and
liabilities. Before we go into current liabilities, where will our pension be?
under
Under no
non-current.
current line.
It's a non-current liability, right?
Yes.
Yes, sir.
Okay. And I think we have our figures for the pension benefits, right?
Net pay must be
So
20.
this is our net pension liability. Abi?
Sir.
Okay, this one has been included in our retained earnings. We've deducted it from our retained earnings. right? Because it's an expense. So our net pension liability, let me call this working 6 and this is working 7. Net pension liability, working 7. What do we have as the net pension liability?
20.
20, ba?
20.
Okay, 20. Then we now have current liability. Is it liability or liabilities?
Liabilities, plural.
Liabilities. 400, 280, and 200. 400, 280, 200. And what will that give us? 880, ba?
Yes.
That's 880.
880. And what else do we have? Any other thing? I'm not sure.
Oh,
Yes.
Uh, so now we can add together
It's balance.
the sum of all of these. 12224. Okay, so here we have our equity and liability. Total equity and liability. Total equity and liabilities. So now we are done with this question. Any question from anyone?
Yes, sir. There's a question.
Eh?
Hello, sir. Can you hear me?
I can hear you, sir.
Okay, sir. So, to start with, I want to apologize. I wasn't in the first class, but I have an observation, more like
Okay.
a question. I don't know if you could assist to clarify. I noticed when computing the figure for goodwill, we use the goodwill of the three entities, that's both parents and the subsidiaries.
Okay.
I was thinking maybe it's just for only subsidiaries, so I don't know why we included that of the parent. I don't know if you could explain. And then the second question is, I don't know, would this worksheet be shared to us after the class?
Yes. So I'll start with the second one. Worksheet to be shared. Uh, is that the two questions you have? Is that your two questions?
Yes, sir. Yes, sir. Yes, sir.
Okay, I'll take it as that's the two questions. So the goodwill now, we did not do goodwill for the parent company. No, the parent purchased subsidiary Rua. The parent also purchased another subsidiary Emily. Then we now have this one. The second subsidiary, which is Emily, is a direct subsidiary. Parent purchased shares in Emily, right? And also Rua itself, who happens to be a subsidiary to Omi, is also a parent to Emily, which means the parent of Omi becomes an indirect parent, another indirect parent to Emily. That's the indirect one we have here. These are the third one. We did not do anything for the parent, right? We have 15 minutes to end this session. So that is what we are simply saying. It's not like we prepared goodwill for the parent company. No, we did not prepare goodwill for the parent company. Okay? We did not
All
prepare
right. Okay.
goodwill for the parent company. So that's what we did. Do you have any questions, sir?
Yes, sir. But this one we did, is it
Subsidiaries. so that if I want to go and get the recorded videos of the beginning of this solution, I would be able to know how we
I don't
got
understand
this
what you
off.
just said.
Okay, so these workings we just did now, is it
Yes.
for sub-subsidiaries or for fellow subsidiaries?
This one.
So that
So
yes,
now
so that
this
if I want
one
to go
is a
and get
direct
the record.
subsidiary. We own this one, a direct subsidiary. We own this one also, another direct subsidiary. And Emily is a sub-subsidiary to Omi, a sub-subsidiary. That's why Omi becomes the indirect owner. Do you understand that, sir?
Yeah, yeah.
So that's what makes Omi an indirect parent company to Emily. Even though Omi is also a direct owner. So we need to separate the three of them.
Okay, all right.
Any other question, please? Shall we proceed now?
Yes, we shall.
Okay. Now, uh, the big question, what does it say? The big question gives us IFRS 9. Have we done financial instruments in this class?
No, sir.
Eh? We've not,
No,
right?
sir, we haven't.
Okay. Okay, that's it. Now, that means we'll come back to that question. Let's look for um, one more question. We'll be taking one more question on consolidated financial statement, right? But this time around, if we can get a question with associates, this is May 2023. Someone else should give us a question. Anyone who has a question on this should please give us. You have anyone with a question?
I think November 2023.
Do we have associates there?
It was
Sorry?
May 2022. He has an associate, but he also has a clean and question.
May 2023.
2022, 2022.
May 2022. Okay. So let's go to May 2022. Okay. Bola, Tanko, and Eze. Bola, Tanko, and Eze. Shall we?
Yes, sir.
Investee companies. Easy. Bola Limited and its investee companies, Tanko and Easy. Okay. Yes, what do we have there? Prepare the necessary adjustment for the lease contract. We've done lease, right?
Yes, sir.
Okay. Then we have income statement and statement of financial position. I think I like this one. Okay. Someone should read the question for us. Someone else, please. Someone else should read the question for us, please.
Okay. So the draft financial statements of Bola Limited Group and its investee companies, Sanko Limited and Elder Limited, at 31st December 2018 are shown below. All figures are deemed to be correct. Draft statements of financial position as at December 31st, 2018.
And let's
All
go to the
figures
additional
are deemed to
information.
be correct. The additional information one. Sorry, can you scroll? Okay. On
Yeah, I'm there.
1st January 2014, Bola Limited acquired 9 million ordinary shares in Sanko Limited for 23,250,000 when the reserves of Sanko Limited were 3 million. Additional information too. A new asset with a fair value of 1.5 was acquired during the year under a lease agreement by Bola Limited. A clause in the lease agreement stipulated that 300,000 payments must be made on 31st December each year for 6 years, starting from December 31st, 2018. The interest rate implicit in the lease is 5.47%. Bola Limited treated this as an operating lease because the only accounting entry that the company believes must be made in relation to this asset is the 300,000 naira payments it has made. 3. Buddha Limited had an intangible asset of 750,000 for software in its statements of financial position. The directors of Buddha Limited believe that the software will have no recoverable value at the date of acquisition. Asanko Limited wrote it off shortly after its acquisition. 4. At the date of acquisition of Sanko Limited, the carrying amount of its PPE considered to have a remaining life of 10 years was 5,625,000 lower than its fair value. 5. On January 1st, 2017, Boda Limited acquired 2,250,000 ordinary shares in Ezo Limited for 6 million when the reserves of Ezo Limited were 1.350 million. The carrying amount of assets of Ezo Limited was the same as their fair values at that date. Depreciation should be treated as an operating expense. 6. A component used by both Samco Limited and Ezer Limited is produced by Bola Limited and it sells this component at a margin of 25% and goods worth 780,000 were sold to Samco Limited during the year. None of these goods had been sold by Samco Limited at December 31st, 2018. Bola Limited also sold goods worth 1.2 million to Ezer Limited and Ezer Limited sold all the goods as at December 31st, 2018. 7. 900,000 naira in respect of amounts owed by Samco Limited and 525,000 in respect of amounts owed by Ezer Limited were included in the receivables of Bola Limited. The corresponding balances in Samco Limited and Ezer Limited payables were 600,000 naira and 525,000 respectively. On December 31st, 2018, Samco Limited sent a check of 300,000 to Bola Limited. 8. There has been no impairment for Ezer Limited. However, the impairment test conducted on Samco Limited's goodwill showed that goodwill is being impaired by 10% per annum on a straight line basis. 9. Bola Nigeria Limited cash and cash equivalents included directors' loan of 1.5 million. The directors of the view that the inclusion does not contravene any international financial reporting standard required. A. Prepare the necessary adjustments to account for the lease contract based on additional information provided in II above in accordance with IFRS 16. B. Prepare the consolidated statements of profit or loss and other comprehensive income for the group for the year ended 31st December 2018. C. Prepare consolidated statements of financial position of Bola Limited Group at 31st December 2018. And lastly, discuss the ethical implication of the director's action in Note 9 above.
Okay, so before then, let's check how many minutes is remaining. And once this minutes clocks out, we'll take 10 minutes break. We'll take 10 minutes break and then we'll resume back immediately. So that means we'll be resuming back at 7:40. Okay. Now, the first question says that prepare the necessary adjustment to the account. The necessary adjustment will not be done in 4 minutes. Let's discuss the ethical implication of the director's action. What's the ethical implication of the director's action? In note 9. So the note 9 says that Bola Nigeria Limited cash and cash equivalents the director's director's loan of 1.5 million. The director are of the view that the inclusion does not contravene any international IFRS, right? So loan of 1.5 million is included. Yes, what does that mean? What's the implication? Eh? The director gave a loan of 1.5 million, and the director is of the view that including that 1.5 million in the loan, I mean in the cash and cash equivalent, does not contravene any IFRS. What does IFRS say? Hmm? Hello?
Hello, sir. Sorry, please. I want to understand that one. Is it the director that gave the company the loan, or the company gave the director the loan?
Director's loan of 1.5 million is included in that cash and cash equivalent. So who gave out a loan? Who gave each other loan? Is it the director that gave us a loan, or we gave a director a loan? Yeah, let's start with that now. Although after all of us are seeing the question here. So what does that mean? Is it the director that gave us a loan, or we gave the director a loan?
It looks like we gave the director a loan.
We gave director a loan. Okay, so if you
Yeah.
interpret it as that, right? And they've included, so when you give director a loan of 1.5 million, hmm, that 1.5 million is still in the cash and cash equivalent, right?
Yeah.
So what has happened there? Does it contravene any IFRS?
Yeah, I think it's kind of the wrong posting. It's not supposed to be sale. It should be under it's a liability. It's not sorry,
Mm-hmm.
it's an asset. It's an asset, not a liability.
It's an asset. Now, if the company is giving director a loan, it's a current
Yeah,
asset,
it's
right?
an asset. Yeah,
Okay,
it's an asset.
okay. So what do we have on it?
The
Now,
class is about
okay. So that means we'll continue from here in our next session, right? So we are resuming back at exactly 7:40.